Welcome back to the Deep Dive. It is January 28th, 2026. And if you're anything like me, you are currently staring at a shoebox full of receipts, or maybe you've got 14 tabs open on your browser. And you are realizing that filing your taxes this year feels weird. Like the whole vibe is different.
It feels different because the entire operating system of the American economy just got a reboot.
It really does. While we were all busy sweating over charcoal grills last summer, specifically on July 4th, 2025, the government signed Public Law 11921. And looking at the stack of research we have today, the actual text of the law, breakdowns from CPA Sherman, analysis from tax attorney Mark Kohler, this isn't just a tax tweak.
No, absolutely not. Calling this a tax bill is, like calling the internet a communication tool. It's technically true, but it misses the magnitude of the shift.
Right. It feels more like a restructuring plan. We're seeing a massive pivot in how the country generates revenue, what we encourage, and honestly, who wins and who loses.
That is the perfect way to frame it. The mission for this deep dive isn't just to tell you which box to check on your 1040, though we will get to that. It's to understand the trade-offs. This bill, Public Law 11921, or as the headlines call it, the Big Beautiful Bill, is 139 pages of aggressive policy shifts.
And the nickname Big Beautiful Bill actually stuck, which is just hilarious to me. But let's look at the architecture here. From what I've read in the sources, it seems like we have two main stories. On one side, you have massive relief for businesses and a very specific slice of the middle class. And on the other side, you have a complete demolition of the green economy to pay for a massive buildup in military hard power.
That is the friction point. We're moving from an economy incentivized to go green to an economy incentivized to, produce, drill, and secure borders.
Okay, let's unpack this for the listener who is just trying to figure out if they owe the IRS money next month. We entered what the campaigns called the no-tax era. Now that the dust has settled, is that actually real? Because I remember hearing no tax on tips and thinking, there's no way the IRS just walks away from that cash.
They didn't walk away, but they did blink. Sections 70201 and 70202 of the bill officially eliminate federal income tax on tips and overtime pay.
So if I'm waiting tables or I'm a nurse pulling a double shift, that extra money is tax-free.
Yes, but, and there's always a but in tax law.
Always.
There are phase-outs. The legislation wasn't designed to be a loophole for high-powered consultants billing hourly. If you're a joint filer earning over $300,000 or a single filer over $150,000, the benefit vanishes.
Okay, so if I'm an investment banker billing overtime, I don't get the break.
Precisely. It's targeted specifically at the working class and the middle class. It's designed to incentivize labor participation, getting people to pick up that extra shift without feeling punished by the tax bracket jump.
That makes sense. Now, here's the one that really caught my eye because it feels like a time machine back to the 1980s. The car loan interest deduction. I thought consumer interest deductions were dead and buried.
They were. But Section 70203 brings it back with a very America First twist. You can now deduct up to $10,000 of interest on your car loan.
That is huge, given where interest rates have been lately.
It is huge, but you can't just go out and buy any car. The vehicle must be for personal use, and critically, it must be assembled in the United States.
So this is where you, the listener, need to actually go out to your driveway and check the door jamb.
Exactly. Check the VIN. If it starts with a 1, 4, or 5, you're likely good. If it starts with a J for Japan or W for Germany, unless that specific model was built in a plant in Alabama or South Carolina, you get zero deduction.
That is fascinating. It's basically a tariff disguised as a tax break. They're not taxing the foreign car extra. They're just paying you to buy the American one.
It's behavioral economics 101. And for the vast majority of people who don't itemize, this might not matter, except
the standard deduction got a massive upgrade, right?
It got supercharged. We're looking at roughly $16,000 for singles and $32,000 for married couples. But the real winner here, and I mean the jackpot winner, is the senior demographic.
I saw this in CPA Sherman's notes. The senior bonus.
It's incredible. On top of the regular standard deduction and on top of the existing over 65 bump, there is a new $6,000 bonus deduction.
Wait, so if my parents are both, say, 66 and retired, how much income can they yield?
If you do the math, a married couple over 65 can essentially have nearly $50,000 of income completely tax-free. before they even start worrying about brackets.
That changes the retirement math entirely.
It does. It effectively turns a huge portion of 401k withdrawals tax-free for the middle-class retiree.
Okay, but we have to talk about the flip side. I have friends in New York and California who have been screaming about the SALT cap, the state and local tax deduction, ever since it was capped at $10,000 years ago. Did they finally get their win?
They got a partial victory. The cap was raised from 10,000 to 40,000.
I mean, 40,000 sounds like a lot, but having lived in the suburbs of New York, property taxes alone can eat that up. Is it actually enough?
For the ultra-wealthy, no. It's a drop in the bucket. But for the upper middle class, say a family in Westchester or Orange County making $250,000, this is a massive relief valve. However, the bill introduces a cliff. If you earn over $500,000, the benefit is restricted.
So it really is trying to thread that needle of helping the regular rich, but not the rich rich.
Exactly. It's distinctively populist in its design.
So that's the personal side. Check your VIN, check your overtime, and if you're a senior, enjoy the bonus. But I want to pivot to the business side. Because reading Mark Kohler's analysis, he was practically vibrating with excitement. He called this the creme de la creme for business owners.
And he's right. If you run a business, even a side hustle, the headline news is bonus depreciation. It's been restored to 100% and made permanent.
Okay, let's break this down for the graphic designer or the guy running a landscaping crew. What does 100% bonus depreciation actually mean for their bank account?
Okay, imagine you're that landscaper. You need a new heavy-duty truck and a bunch of mowers. Total cost, $80,000. Under the old rules, you'd have to split that deduction over 5 years. You'd get a small tax break this year, a small one next year, and so on.
Which doesn't help me with cash flow today.
Right. With 100% bonus depreciation, you buy that $80,000 of equipment and you deduct the full $80,000 from your income this year. It can literally wipe out your entire tax bill for the year if you time it right.
And this brings us to the December truck strategy that Kohler mentioned. This sounds like one of those things that feels illegal but isn't.
It's aggressive, but it's the law. The strategy is this. You realize in December that you're going to have a massive profit for the year. So on December 20th, you go buy that $60,000 truck. You put it into service, meaning you actually use it for work, before December 31st.
Even if I only use it for 1 week.
Even if you only use it for 1 week, you get the full deduction for the year. However, and please, listeners, lean in for this part because this is where people get burned. There's a trapdoor.
I knew there had to be a catch.
It's called recapture. Let's say you take that huge write-off in 2025. But then in 2026, you stop using the truck for work and start using it just to drop the kids off at soccer. If your business use drops below 50%, the IRS essentially says, hey, we gave you that break because you said this was a work truck.
And they take the money back.
They retroactively tax the income you wrote off. It's messy, it's expensive, and it involves amending returns. So if you use this strategy, you have to commit to keeping that asset as a business asset.
So don't buy the company G-Wagon if you're just going to drive it to the mall next year. Got it.
Precisely.
What about the QBI? The qualified business income deduction. That was a huge deal when it first came out. Basically, a free 20% discount on your taxes just for being a business owner.
It was set to expire, which was a ticking time bomb for small businesses. This bill makes it permanent. This is crucial because it keeps the playing field somewhat level between the local bakery, a pass-through entity, and the massive C-Corp down the street. It's a structural support beam for the small business economy.
And speaking of structural support, I saw the estate tax exemption is locked in at $15 million per person.
$15 million per person. Index for inflation. So for a married couple, you can pass on $30 million to your kids tax-free.
$30 million. That is a lot of money. That's basically creating a permanent landed gentry if you think about it.
It's certainly protecting generational wealth. If you combine that with the permanent step-up in basis rules, we're talking about dynasties being able to preserve capital indefinitely.
Okay, so we've just listed billions, probably trillions of dollars in tax cuts and incentives. But this is a reconciliation bill. The math has to balance, or at least pretend to balance, who is paying for this party.
This is where we get to the restructuring part I mentioned earlier. The bill pays for these tax cuts by essentially defunding the green energy transition.
Like all of it.
It's a scorched earth approach. Section 70501 explicitly terminates the Green New Deal subsidies.
So let's make this concrete. If I walked onto a car lot today, bought a brand new EV, and expected that $7,500 tax credit.
It's gone. Repealed. And not just for new cars. The credit for used EVs. Gone. The credit for installing solar panels on your roof, repealed. The credit for clean hydrogen production, terminated.
Wow, that is an abrupt slam on the brakes for that entire industry.
It is. If you were a solar installer or an EV startup relying on those subsidies to be price competitive, your business model just evaporated overnight. The bill explicitly pivots that funding toward energy dominance.
Energy dominance sounds like a wrestling move. What does it mean in the law?
It means oil, gas, and coal. The bill mandates leasing for onshore and offshore drilling. It reopens coal leasing. It even blocks funding for clean, heavy-duty vehicles.
So it's not just removing the carrot for green energy. It's putting the government's thumb on the scale for fossil fuels.
Correct. It's a philosophical statement. Cheap, abundant domestic energy is the priority, regardless of the carbon output.
And that revenue from the oil leases and the savings from cutting green subsidies, that isn't just going to tax cuts, is it? Because I looked at Title II of the bill, and it reads like a Tom Clancy novel.
No, it's going directly into hard power. We're seeing a security explosion. The bill appropriates massive sums for the Department of Defense with a very specific focus on the Indo-Pacific.
I was reading the shopping list of hardware, and it seemed very specific. It wasn't just more money for the Army. It was landing ship mediums. What even is a landing ship medium? Is that a ferry?
Think of it less like a ferry and more like a tactical lily pad. If you look at the geography of the Pacific, it's thousands of tiny islands. In a conflict with a major power, you can't just park a massive aircraft carrier sitting duck in the middle of the ocean. You need to disperse. These landing ship mediums allow the Marines to hop from island to island, setting up mobile missile batteries and radar stations. It signifies a shift from big, heavy wars to distributed agility.
And they're buying the missiles to go with them, right?
Huge investments in LRASM long-range anti-ship missiles and maritime mines. This is a denial strategy. It's about making the ocean too dangerous for an adversary to cross.
It's wild to connect the dots here.
Yeah.
You lose your tax credit for an electric car in Ohio, and that money effectively buys a sea mine in the South China Sea.
That is the direct line this bill draws. And it's not just the warm waters. The Coast Guard got over $24 billion for mission readiness, which specifically funds polar security cutters.
Icebreaker.
Big armed icebreakers. We are seeing a race for the Arctic and Antarctic resources, and this bill makes sure the U.S. has a seat at that freezing cold table.
And speaking of borders, we have to touch on the literal border, Title IX.
The border infrastructure and wall system. The bill pours billions into physical barriers, detention capacity, and enforcement personnel. But there's a fascinating mechanism here for how it's funded.
The fees, right.
Yes. They are trying to make the immigration system self-funding. The bill introduces significant new fees for asylum applications and employment authorization documents.
So if you're trying to come in, you are helping pay for the wall that keeps you out.
In a cynical sense, yes. Or at least paying for the processing of your own case.
We've covered taxes, energy, defense. But what about the social safety net? Usually, when you boost defense and cut taxes, social programs take a hit.
And they did. The bill significantly tightens S&IP food stamps. It raises the age limit for work requirements for able-bodied adults, meaning if you're 52 and not raising kids, you need to be working to get food assistance.
But there was also this thing about the Thrifty Food Plan. Can you explain that in plain English? Because it sounded like bureaucratic jargon, but the sources made it seem important.
It's incredibly important. The Thrifty Food Plan is basically a theoretical shopping basket the government uses to decide how much money a SNIP recipient gets. If the basket costs $200, you get $200.
Okay.
In the past, administrations would update the health quality of that basket, adding more fresh veggies or fish, which raise the cost and therefore raise the benefits. This bill bans that. It forces the plan to be cost neutral.
So they can't improve the quality of the food to increase the payout.
Exactly. It locks the benefit levels in place, adjusted only for inflation. It's a stealth cut to future benefit increases.
But here's the contrast. While they squeezed the food shoppers, they boosted the food growers.
The farmers made out very well. The bill raises reference prices for commodities like corn, soybeans, and wheat.
Explain reference price like I'm 5.
Think of it like an insurance deductible. The government says corn should be $4.10 a bushel. If the market crashes and corn sells for $3.50, the government writes the farmer a check for the difference.
So it's a guaranteed floor.
It's a safety net. So again, look at the pattern. Business owners, producers, and farmers get a reinforced safety net. Consumers and social welfare recipients get a tightened belt.
So we've dissected the bill. We know the winners, Business owners, seniors, the military-industrial complex, and the losers, green tech, SNAP recipients. But let's bring it back to right now. It is January 2026. What do you, the listener, need to do?
First, stop operating on autopilot. The rules you learned over the last 10 years are gone. If you're a business owner, you need to look at your capital expenditure strategy immediately. With permanent bonus depreciation, the math on expanding your business just changed.
And for the individual.
Check your withholding. If you're a senior, you might be having too much tax taken out of your pension checks given the new standard deduction. And if you're planning to buy a car, look for that Made in USA sticker.
And maybe rethink that plan to install solar panels this spring because the rebate check isn't coming.
Exactly. But I want to leave the listener with a thought about the bigger picture.
Here is where it gets really interesting.
We just talked about how this bill locks in permanent tax breaks for businesses to encourage investment. That's the classic economic theory. But look at where it encourages investment.
Fossil fuels, traditional manufacturing, defense.
Right. By removing the subsidies for green tech and heavily incentivizing the old economy, the government is picking winners. My question is, how will this reshape American innovation over the next decade?
That's a great point. If the smartest engineers in the country realize there's no money in battery tech anymore, do they all go work for Raytheon or Exxon?
Exactly. Are we sparking a boom in industrial capacity and military might, while simultaneously causing a brain drain in the technologies of the future? The tax code isn't just about money, it's a statement of values. And Public Law 11921 has made our values very clear: security, production, and traditional energy.
It's a massive pivot, and we are going to be feeling the ripples of this for a long time. Go check your VIN numbers, call your CPA, and maybe take a look at those island hopping ships. They are fascinating. Thanks for joining us on this deep dive into the big, beautiful bill. We'll catch you on the next one.